So even though there's going to be material up on the screen, you don't need to feel that you need to watch that and go back and forth. And all the materials can be emailed to you after the conference. My contact information will be on the last page. As Marty said, literally spent 100% of the last 25 years of my life focusing on royalty financing and revenue interest financing. I'll explain the difference between the two, and understanding that the audience today of family office is really from two perspectives. Number one, many of you will have invested in portfolio companies of yours for which this form of financing might be appropriate. And then secondly, for family offices that are private credit, private debt investors, this form of financing might be their transactions that you might be interested in participating in the future. But today is really just an educational presentation explaining this form of financing, and Marty's been generous enough to advance the slides. As Marty said, we've known each other for close to 20 years. This is my first time participating in the IvyFON conferences, but I look forward to being a much more active participant. I worked on a successful royalty financing with one of the other participant speakers today, Mark D'Souza, when he was at Diax, and I'm working on currently a transaction with one of the other folks here today, but I won't talk about that because of FINRA restrictions on confidentiality and marketing. But I'm not marketing anything, I'm not selling anything today. It's just purely education. So next.
Yep. There's some latency between my laptop and that.
Sure. So I'm going to start with a few definitions. And this presentation will run, leaving specifically a few minutes at the end for questions. So save any questions at the end and we'll go through them. So first, some basic definitions. What is a royalty / revenue interest financing? So it's basically an investor who receives a temporary participation in royalties or revenues of either one product or a basket of products, or all the revenues of a company that has a recurring revenue model. I'll explain in a little more detail. And they continue to receive that royalty interest until they've received a negotiated capped return, which can either be expressed as a multiple of invested capital, MOIC, or as an IRR. And how does this differ from a royalty revenue interest purchase? A royalty revenue interest purchase is the purchase of a perpetual or permanent participation in royalties and revenues of a product with an uncapped return. But today we're going to be talking about a capped, negotiated capped rate of return royalty revenue interest financing. Just quickly, the difference between a royalty and a revenue interest. A royalty is something that exists when the creator of a product, like a development stage R&D company, develops a product, goes through clinical trials, gets it approved by the FDA, then they license it to Merck, Glaxo, Pfizer. Pfizer pays them a royalty as a percentage of sales, and then this financing is available on the royalties that the licensor receives. A revenue interest is simply for a company that markets its own products, develops the product, and markets. A revenue interest is simply a synthetic royalty. It's basically a royalty that's created just for the purpose of doing a financing. So they really are very similar. So I'll refer to it as royalty or revenue interest financing. So there's a simple block diagram at the bottom of the page. It basically shows how this works. The RIF, so revenue interest financing is a RIF. The RIF investor provides capital to the company. The company gives them a revenue interest security. Money is coming in the form of royalties, or money is coming into the company from customers who buy the products of the company, goes into a lockbox. The lockbox has two sub-accounts, one for the RIF investor, one for the company. So if the RIF investor is getting a 10% temporary royalty on a specific product, the revenues go in. The RIF investor gets 10%, the company gets 90%. There's some specific benefits of using a lockbox structure, which I'll explain as we go through this. Basically, using this lockbox structure does not take away at all from the time when money comes into a company from customers, that money becomes available to the company. It's all same day. So this doesn't detract. Now let's go to the next part.
Yep. Right.
So start out just with some background, little background. So I co-founded Paul Capital Healthcare in 1999, 25 years ago, and as a general partner of Paul Capital, co-managed the raising and deployment of about $1.5 billion of royalty purchases, meaning uncapped, as well as these royalty revenue interest financings over 15 years. Today, $1.5 billion actually doesn't sound like a lot of money, but at the time when we created this fund, we were the first institutional fund providing royalty financing to the pharma, biotech, medical device industry. The total volume of royalty deals across all deals everywhere in the world was about $50 million annually. So at that time, $1.5 billion was a much larger number. And at Paul Capital Healthcare, we were responsible for really developing these synthetic revenue interest financings, developing the market for that. So today, there are approximately $3 billion annually of these financings in the healthcare market. And this form of financing has actually overtaken term debt financing for biotech, pharma, medical device companies that have valuations or market caps of $5 billion and less. So this form of financing is actually now more popular than term debt, and I'll explain why that's the case, because it's literally the most form of financing as an alternative to equity and traditional term debt. It's basically a third form of capital. The interesting thing is that there are approximately 35 or 40 billion-dollar funds that provide this capital. And because of their fund sizes, there's a vacuum in the market for transactions that are 25, 50 million and below. As all of you know who are investors in funds, if there's somebody who has $1 billion fund, they can't do $25 million deals because it would take them 1 million years to invest their whole fund. So the success of this form of financing and popularity has created a vacuum in the market for deals that are 25, 50 million and below, which makes this an attractive area for family offices to invest either on their own or in combination with some other family offices. I'll be taking you through some of that. So, and although most of the transactions that I focus on are in healthcare, maybe 90%, there's an equally large and attractive opportunity for companies in other sectors outside of healthcare that have recurring revenue models. So that includes SaaS companies, software as a service. So any of you that have Office 365 on your computer, you pay some amount of money per year to Microsoft. That's a royalty. Microsoft certainly doesn't need this financing, but other SaaS companies, perfect form of financing for them. Franchise model companies. All the Dunkin' Donuts that all of us love to go to for coffee, those locations are not owned by the company. Those are franchises, and those franchisees pay a royalty on their sales, certain percentage of sales, up to Duncan Holdings or whatever the holding company is today. Those royalties received by the franchisor can be used effectively to finance, and I'm not going to go into it today, but as a follow-up, I can explain many really cool applications of this form of financing by franchisors to do other things, to fund significant expansions and growth and acquisitions, et cetera. Other subscription and utility-like companies, like many of us here today, I don't know if we have any options other than Con Ed to get our electricity, but companies that are utility-like or have subscriptions where they're very sticky relationships between the customer and the company, that form of financing is also very appropriate for them. And other licensors receiving royalties, music, publishing, clothing, branded pop products. Like, for example, when LensCrafters sells Ralph Lauren glasses, Ralph Lauren is not making those glasses. LensCrafters has licensed the use of the name and the logo, and they pay a royalty to Ralph Lauren. Okay, next. So going to be now taking this from both two perspectives. First, the company perspective, the company that's raising the money. So this capital, these transactions are typically structured either with all the money at closing or some at closing with other tranches. It actually provides more money. The same company can raise more money using this form of financing than traditional term debt. Why is that the case? Traditional term debt, typically 5 years, is sized either as a multiple of existing cash flow or how much cash flow the company is expected to generate over the next 5 years until the maturity date. And that's typically how term debt is sized. Royalty and revenue interest financings do not have a maturity date, which has some other benefits for the company, but that means that the investors here are not expecting to get their full return in 5 years. It might be 7 years or 8 years or 9 years or 10 years, depending upon the assets in the company. And that means that this form of financing can generate at close a larger amount of money than term debt for the same company and the same assets. This money can be used to fund acquisitions, fund product launches, fund product development, not funding the purchase of helicopters and things like that, but real business uses. So the investor here, again, receives a temporary royalty in revenues until they've received a negotiated capped rate of return. For larger companies, more established with higher levels of cash flow, the effective cost of capital is comparable to term debt coupon of between 10 and 13%. It's definitely possible for some very large companies with lots of cash flow for the cost of capital to be even much lower than that. But for most companies that are stable, the cost of capital is about 10 to 13%. By the way, this cost of capital is uncorrelated to the equity markets and surprisingly uncorrelated to the credit markets and term debt. So as you've seen interest rates go up significantly over the last 3 years, the cost of capital for these financings has actually not ratcheted up. For smaller businesses, the effective cost of capital starts at sort of mid-teens, lower mid-teens, depending upon the risk of the assets, et cetera. Interestingly, importantly, RIF transactions are not a replacement for company formation equity capital. The RIF investors are not taking the basic equity risk of starting a new company. However, importantly, RIF transactions are viable for companies that are not yet EBITDA positive. However, companies don't have to be EBITDA positive today. However, their recurring revenue model needs to clearly demonstrate that the company will be able to get to EBITDA positive over the next 1, 2, or 3 years, with the RIF capital effectively kind of being a bridge to help the company fund its operations. I'll take your question after. To fund the company to become EBITDA positive. So for companies that need growth capital, RIF transactions are more favorable than raising equity or traditional term debt. Here are a few of the reasons why. Number one, it's non-dilutive. The RIF investor is not getting warrants. They're not getting equity in your company. Number two, there's an absence of a maturity date and typically does not have financial covenants like term debt does. And therefore, this form of financing literally cannot create financial distress risk for the company that raises this fund. This form of financing cannot push a company into bankruptcy. Typically has a narrow security interest in term debt. You get term debt for a company, the security interest in the collateral is all current and future assets of the company. Use RIF financing, let's say a pharma company, I'll just use that as an example, even though again, it's applicable to a lot. Pharma companies doing a RIF financing on one product, the security interest, the collateral is limited to that one product, leaving all the other assets of the company basically unencumbered to do other financings. Number four, the payments to the RIF investor are treated as interest expense, as is our payments to term debt. So RIF financing also serves as a shield to taxable income, just like regular debt. So it has the benefits of debt without having all the problems that could put companies at risk of bankruptcy. It's much less expensive than raising equity capital, certainly in the equity markets of the last 3 years. And it's comparable, and I'll explain what it's comparable to the cost of raising term debt. It might be 100, 150 basis points higher than the coupon for term debt, but because you can raise much more money, as we discussed, than term debt, because it's not subject to being repaid over 5 years, even if the cost of capital is 100 to 150 basis points higher, the fact that you can raise much more capital means that the return on equity to shareholders of that company are going to be higher when a company uses this form of financing as opposed to term debt. And sometimes the cost of capital for the RIF financing is actually the same as term debt, but in many cases it's 100 to 150 basis points higher.
Is that a question?
Can I answer it right after? Just so I can go
Bankruptcy of the company.
Yes, and I will address that in particular on the next page, not yet, as an investor. And as I said, it's uncorrelated with the equity markets and the credit markets, primarily because the source of capital, like in many private equity funds, is governed by the pref, the investors. And so the cost of capital is relatively sticky. And when interest rates go up, the cost of this form of financing doesn't go up as quickly or as much. Okay, on the next page, thanks, Marty, we're fine on this page. Now I'm going to discuss from the perspective of the family office as an investor. So you will have the opportunity in some of these deals to either purchase a perpetual uncapped royalty interest or revenue interest, or today what we're talking about are the negotiated cap returns. For investments in larger companies, the RIF transactions typically provide a return to the investor of a MOIC of between 1.45 and 1.75 multiple of invested capital, which typically translates into an IRR between 10 and 13%. So it's comparable to a 10 to 13% coupon
Is that over 10 years?
over much shorter, 10 years, 7, 8 years. It actually has the same risk profile, and to your question, for the investor, it's actually a better risk profile if the company ever goes into bankruptcy, and I'll explain why. If you as a private credit investor from your family office invest in term debt, if the company goes into bankruptcy, any interest that you earn after the date that the company goes into bankruptcy is treated as what's called post-petition interest. So even though you might be a secured term debt lender to a company, all the interest that accrues after the company goes into bankruptcy is at risk of being cut back, discounted by the court, argued with by unsecured creditors. Here, if you're negotiating for 1.75 multiple as an investor, there's a self-executing put option that gets executed before the company goes into bankruptcy. So your entire 1.75 return is treated as if you had earned it before the company goes into bankruptcy. So as an investor, you're not subject to the risk. I'll be done and I can answer your question now. Is not treated to be treated as post-petition interest. And this has been tested in multiple bankruptcies, and this form of financing has sailed through. So as an investor, you have a protected, and frankly, from the company's perspective, they don't really care because at that point, you're just negotiating with other unsecured creditors in the company. So it protects you as an investor from other unsecured creditors to the company clawing into your negotiated cap return. So I said in larger companies, the cost of capital, a MOIC of 1.45 to 1.75 translates into a IRR between 10 and 13%. For smaller companies, the RIF transactions have an attractive return profile that start in the mid-teens. So that might be a multiple of 2x and can be 3x or 4x, or more, depending upon the specific company, the risk of the assets, et cetera. But as an investor, you can basically earn equity-like returns in some of the smaller companies, but having the protection of being a credit debt investor. I mentioned this lockbox earlier. So you buy, for example, a percentage of revenues or royalties associated with lens crafters licensing from Ralph Lauren, the right to use the Ralph Lauren name and logo on the glasses. Those royalty payments are paid by lens crafters into a bank account. I mean, lens crafters think they're just paying into the normal company bank account at whatever bank they use. But this bank account is a segregated, separate account that basically has, just for the purpose of receiving these royalties, has two sub-accounts, one for the RIF investor and one for the company. And so what this means is, if you're a lender through a term debt to a company that's going through problems, you're going to get paid at the discretion of the company, right? Not the company has or when the company wants to pay you. If you're an investor in a RIF transaction, you get paid when the customer sends in the royalty or the revenues. You get paid at the exact same time that the company gets paid. You get your 10%, the company gets their 90% in the example of the 10% temporary royalty. So the amount and timing of when you receive your money as an investor is not subject to the discretion of the company. You're also getting it off the top. So again, it's more protected.
5-10 minutes.
Yep, we're so good. I mentioned the RIF capital cannot cause a bankruptcy, but in a bankruptcy, it is better protected even than term debt. Again, because the treatment of your full cap return being something that is not treated as post-petition interest. So there are going to be many transactions of this sort in the $10 to $50 million range. If that's the bite size of your family office. If your bite size is smaller than that, there might be opportunities, there are opportunities to cobble together, 2, 3, 4, hopefully not more than that. Family offices participating together, or a family office who might only have $3 to $5 million. That is the end of the formal presentation, but in the materials that you can get by email, this next page just lays out some of the experience in the pharma. And the next page, Marty.
So these pages currently is a sample deals that have happened.
Yeah. Next page. This page, this is fine. This page takes you through the timeline for the company raising this form of financing. It's about 3.5 to 4 months. So it's, not like equity, which in a public company, which gets raised, or a convert that gets raised overnight. This does take some planning. It's a very well developed market for larger companies. Again, all this stuff you'll get. So you can, it's fine to take screenshots of this, but you can get all this. We'll get it emailed.
We're gonna forward it to you.
Okay.
All right, next page. So when I was a consultant at Bain & Company, we loved these stoplight charts. So this basically compares revenue, interest, royalty financing with term debt, convertible debt, other forms of non-dilutive capital along a number of dimensions. So it can help explain.
So what's the duration of the royalty debt again?
So here, it's basically undefined. It's the investor has to patiently wait until their percentage of revenues get them their negotiated cap return. It's typically structured based on a model that the investor is comfortable. You'll never know what the investor's own projections are, but it's typically structured so that the investor expects to earn their full return in 7 to 8 years. But it could be that the investor has to wait 9 years or 10 years.
Got it.
And it's possible that it could be much quicker. Yes.
Is it, did you have a question?
No.
Is it possible to custom tailor it and put in some puts and calls and conversion to common and
Yes.
conversion to senior secured term loans?
Well, this is senior secured. It is already senior secured, so you don't need to worry about that. But yeah, all sorts of all sorts of things can be added. I guess next, just there's my bio. The next page is the bio of my senior most junior colleague, and then on the last page, that's my contact information. But you could definitely take a screenshot of that. Okay, so any other questions that I have?
Yeah, one more. Based on your comments, it would appear it would not matter whether the parties are public or private.
Correct. This is equally, the investors here do not care whether you're public or private. It does not matter.
How do you perform diligence on the commercial uptake of a product?
Okay, so number one, as the banker representing the company raising this money, because all I have is my time, I will diligence this as best as I can, because the last thing I want to do is spend multiple months on something that doesn't close. When I invested money at Paul Capital, on the $1.5 billion that we raised and deployed, we only lost money on 50 million of the $1.5 billion. So we had less than 1x on 50 million and 1x or higher on 1.45 billion. So we did a pretty good job underwriting risk.
Do you underwrite?
But this, by the way, this is not an underwritten, these are not underwritten deals.
Is this same true for first-in-class products?
Yeah,
That are market makers.
here's what it's good for, here's what it's not good for. It's good for differentiated products. It's not good for your children who set up lemonade stands. It's not good for Me Too products. It's really good for products that are they don't have to be the leaders in their market, but different segmented. For example, Planet Fitness, which many of you might laugh about, because it's only $10 a month. Planet Fitness has a 35% EBITDA margin at $10 a month. That's one of the strongest, most defensible business models on the planet. Even though you might laugh about it because it's, you wonder how can a company that charges $10 a month do that well? Yeah.
How is the recipient company, what's the gap treatment of an RIF? Is it
Yeah,
a?
it's OID, it's OID income.
Oh, what is it?
OID, it's treated as OID income.
Okay.
And for product launch investments for RIP for that, but the company can turn EBD positive in 2 to 3 years.
Yeah.
And
It's very frequently used to fund commercial launch.
so if they're pre-revenue though,
Yeah, I mean,
it's still okay.
for pharma companies,
Yeah.
like on the day the product gets approved by the FDA, these financings close and funded on that day.
So usually funded upon approval. That
Yeah, and if it's funded prior to approval, it's gonna have a much higher cost of capital, but the cost of capital that I've been talking about here are for companies that are commercial stage. They might not be the DA positive yet, but they are commercial.
So that approval being the mechanism.
Yeah, I mean, Lionel didn't pay me to be here. I didn't even know he was speaking, but when we did the deal with Diax All Capital, right? We had two businesses. One was a phase 3 asset that was being positioned for launch. Markets were terrible. And the other was a licensing platform that the market gave us no value for. So we monetized the royalty or the RIF from that licensing platform to fund our phase 3 clinical trials.
Yeah,
And it worked out just like Lionel
Yeah,
said.
and on the day that Diax announced that financing, we basically had the equity analysts from Deutsche Bank say, we never gave $1 of value to this licensed and funded research program of Diax. And Paul Capital has done this capped return, so now we need to add X $100 million to the market cap of Diax. And we've never even, so this can also be used for public companies that have sort of a hidden asset that's not being valued by the market to basically telegraph to the market that a well-heeled institutional healthcare investor has provided X for an X% share. So it basically helps to set like a floor value.
What percentage of the deals are what you would describe as IP royalty deals of patent royalty deals versus brand name?
Yeah,
Deal.
brand names could be very strong. So for example, at Paul Capital, we did a deal with UCB Pharma, the Belgian company, who was getting a royalty on, I forget what allergy drug that was originally marketed by Upjohn, then Pfizer. And we got a royalty based on the use of the trademark name. But it wasn't based on licensing a drug. It was basically the trade. We felt very comfortable with that. We did our diligence, of course, but it could be used. It doesn't have to be done on patents. In fact, it doesn't even have to be done on products that are patented. Think about like Midas Muffler. It's a franchisee model. We presented to Harvest Partners and explained how we could use a facility to help Harvest Partners buy independent mom and pop muffler shops, convert them to Midas shops, and then repaid out of the revenue payments from the franchisee up to the franchisor. There was no IP. No IP. Deloitte and Company, the consulting firm, accounting firm, is structured as, it's actually the whole world. There are just lots of, every country has its own entity to basically protect the partners in one country from the risk of other. So basically Deloitte receives a royalty from all the different countries into the parent. We helped show Deloitte how they could use that royalty stream. They could use that to finance the acquisition of a large consulting firm, for example.
Where's the parent, by the way?
And in the US,
Not in Switzerland?
I don't think so.
So Planet Fitness, because of the tanning booths, is why it makes so much money.
Because it's very low cost, because most of the people that pay the $10 don't go.
Incredible.
Because nobody cancels
So
a
you-
$10.
Utilization, yeah.
Nobody cancels a $10 membership.
And also, and so you can actually, you're doing a financing, so you're getting paid. What's the percent in advance you're getting like a lump sum of a certain amount? And-
Yeah, so the company raising this money can either get it all up front, or maybe it's more valuable for the company to get some upfront and some tranches over time as it needs the capital. So it can be structured both.
And what's the typical amount? Like a 70% of what the RIP or?
The way to think about it is, in most companies, it's really hard to answer the question exactly the way you've asked it, but companies can raise 10, 25, 50, 100, 300 million. I'm working on a $1 billion thing with Hungarian toll roads right now to help finance the construction of toll roads.
Yep.
You can do this on billboard, advertising revenue, anything that's like recurring revenue. Subscription, exactly.
But it's not factoring.
No. The factoring is typically a bucket of receivables that exist at one particular time, and it's just discounting those particular, whereas this is an ongoing participation in revenues that's temporary, that's capped and negotiated at a capped rate of return. Factoring is really like a one-time thing, just like a bucket of receivables by a company that needs the money desperately.
And the target rate of return is 10 to 13%, you said?
So for companies that are, very stable, medium, large, I mean, it's harder to find large companies, it's like the equivalent of 10 to 13% coupon. For companies that are smaller, it could be 14 or 15%, or if it's very risky, it could be something where say, if we give you X dollars, you can have it at a 15% rate of return. But if you want 3 times as much, we'll structure it at a 2.5 multiple or a 3 multiple. So there's lots of different ways it could be structured.
Just as a funny point, when I think of royalties, I always think of Mr. Wonderful from Shark Tank.
Right, it's just that on a
Kevin O'Leary.
22-minute program,
Yeah.
it's mind blowing for these people. They're going to raise, I want to sell you 10% of my company for 200,000. He's like, I don't want any of your equity.
No.
I'll just get a royalty, and they're just like starstruck because they don't even know what he's talking about. So it's tough on a 22-minute program for somebody who's going to raise equity to encounter him saying, trying to negotiate in real time.
What about apps? Like upper 90, I don't even know upper 90.
Yeah, but I would love to structure something based on all the revenues that Apple gets from its
that's
egregious.
But 30% of revenue,
Right. But yeah, sure. I mean, apps for things that are recurring, I still pay money on Consumer Reports for my app, even though I don't use it that much, but it's not that expensive, so I don't cancel it. So if it's seen as a pretty sticky app with sticky customers, then it's more likely. If it's something where someone's likely to cancel it, then it's harder to structure.
So Lionel, I understand the concept of, what you're doing, and I've been in the capital equipment business my whole career, in a couple of different industries. And, it works when there's underlying assets, it's securitized loan. I'm trying to understand for like digital assets, what's the security?
Well, it depends. I mean, if there's a subscription involved, so give me an example of a digital, something that you're thinking about, and I'll help you understand.
Any I don't know, like any subscription agreement, Hulu.
Yeah, I mean, for example, I don't know about you, but I am constantly optimizing and canceling Hulu and then signing back up for 6 months later.
It doesn't matter if you're rich or not. Everyone wants to save $20, right?
Right, exactly. So again, you look at how sticky if there's a track record of it being very sticky and if it's something where 40% of customers wind up churning or canceling, you just structure the RIF on the assumption that, 40% are sticky, and then that means you just raise a little less money, but the investor could become comfortable because of what the typical churn rate is, and they just don't assume that 100% retention, they assume 40% retention, and then it'll be structured appropriately for the risk of
Do you do capital equipment financing?
yeah, so companies, for example, like medical device companies that are stuck in the situation of they want to earn their money on the use of the capital equipment, and they want to be able, so it can be used to provide, to place capital equipment in hospitals. Sure, it could be used for like Xerox machines, which have an infinite life, sort of.
But your firm doesn't specialize only in healthcare. You can do it across.
We do not specialize in healthcare. We do focus on it.
Yeah.
When you started something 25 years ago and the phone's always ringing, that is where through a lot of referrals, et cetera, that's where a lot, but I'm working on something, as I said, Hungarian construction of looking at toll roads in Hungary, for example.
And that's something that should be a provenance primarily of like private equity firms that were doing infrastructure, but that's
Yeah,
interesting.
infrastructure funds like Macquarie,
Brookfield.
or there are special situations. So the definition, if you've ever heard of the term special situation funds or credit strategy funds, what does that mean? Those are lenders who are not constrained by the box of having to provide 5-year term debt.
Yep.
5-year term debt is the stupidest invention in the world. And the only reason it's 5-year term debt, because that's not what companies need. That's because the reason they do that is if everything's structured the same, then a bank that provides that can then offload it and sell it. But if it's investing in all these different maturities with all these different structures, it's very hard for banks to provide money and then get it off their balance sheet. That's why the 5-year term debt market exists. It doesn't exist because companies say, oh, I'd love to borrow money and have to repay it in 5 years. It's
I think
really-
there's a lot more questions, but unfortunately, we don't have time for that. Hopefully, we'll see you at dinner or at least for drinks. I had questions like, are there restructurings? How do you restructure?
Yeah, I'm happy to provide, so my contact information is there. I'll be there for drinks and part of dinner tonight. I'll answer any question that anybody has. Problems.
Fantastic. Lionel, thanks so much for honoring me.